Welcome to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Hey, good morning, listeners. I wanted to take a couple minutes to share more about what to expect from future episodes of Financially Fluent. We plan to keep each episode between 25 and 35 minutes. So this particular episode is actually going to bring you to you in two parts. We'll have part one released on a Tuesday, and then we'll do part two released a couple days later. So it is with a CPA, and I thought, hey, you know what? What are some good questions for our audience to ask a CPA? Maybe you don't have a CPA yet, you thought about getting one, or you're in the midst of changing. Here's some good questions that you might want to ask them. First is, find out what kind of experience do they have working with clients in your same income bracket, or even in your same profession, same industry. Another one would be, ask them what's the process for them staying up to date on their changing tax codes. Hopefully they have a process, but they may not. And so I think asking them that question should give you a sense of, how they operate. Are they more reactive or more proactive? How do they communicate with clients? That might be the most important questions for a lot of people. Ask them what that process is like. Is it email? Is it phone call? Do they schedule time to check in? Is it once a year, twice a year, more so? Is it with a team member? Is it with them? Nothing wrong with having a team member, but it's just good to know, what you can expect from a communication style standpoint. And the other question would be, I always think it's good to ask them, can you walk me through how you help the client reduce their tax liability, or maybe avoid a costly mistake, and just kind of listen and see. And I think with those questions, you will get a good feel for, if that's going to be the right fit for you. And hopefully the answers you get are all what you find out in reality is what you're actually getting. And there's probably listeners here that are very happy with their CPA, and that's always a good thing. So I'm happy to hear it when that's the case. But for today, we'll give you a little preview who the guest speaker is. It's a CPA. We work with a lot of them. This particular one, his name is Josh Roper. And so you could be a person that's a W-2 employee, you got fairly simple tax returns, you do it on your own, that's fine. But there are listeners that have more complex issues, that are dealing with real estate holdings, they own a business, they're doing a side hustle. Maybe even your taxable accounts can add some complexities to your tax returns. So I love collaborating with CPAs, and over the years, like I said, we've formed some very good ones. As a financial advisor, we're here to help grow your wealth, protect your wealth, but you do want to have a trusted CPA give you those real tactical tax advice answers, making sure that you're kind of staying compliant. And so anytime you can collaborate together and plan in a tax smart way, that's kind of the way to go. So thanks for listening. Hope you enjoy today's episode of Financially Fluent. Hey, good morning, everyone, and welcome to the next episode of Financially Fluent. Today, I'm very excited to have a CPA on with us, Josh Roper with Altruis. How are you doing today, Josh?
Doing well, Ray. How are you today?
Doing good. The date of this recording is May the 13th. So for you, we've made it past April 15th. We've made it past May the 1st, but I guess you're still busy.
Yeah, it's a lot of extensions and just trying to get them out of the way, so maybe we can take a vacation this summer. But yep, still staying busy.
Good deal. And have you been doing this for a while?
I'll complete my 25th year this August, so I'm excited about that.
Wow, that's awesome. Been doing it since you're 15. That's impressive.
Yeah, I just look young.
That's good. All right. Well, you probably have heard that most guests do answer trivia questions, but we'll hold that towards the end of today because I got quite a few things to ask, and I think our audience might appreciate it. So I know while you have a specialty when it comes to who you tend to work with, kind of have knowledge that is in more than just the specialty area. But let's start right off with, because a lot of people I talk to are business owners. Some might be what I call solopreneurs. They're just one person, or maybe it's two people that are married or have a kid in the business. And then of course we got folks that have many employees. So one of the common questions that I come across is, when should I get an LLC? When should I file as an S-Corp? When should I be a C-Corp? I mean, what are some things they might need to think about when figuring the answer to those questions?
Sure. Like with a lot of tax questions, the answer is it depends, right? So in situation with entity selection, it depends on what your end game is, right? So if you're a small business and you want to grow a business really quickly and reinvest all of the profits back in the business and sell it, then maybe a C corporation would be a good idea because they have a Section 1244 election or section where you don't have to pay capital gains within certain parameters. So C corporation might be the way to go. If not, generally, then if you're not going to be a C corporation, then you start with the sole proprietor and then work your way LLC into the S corp and partnership, et cetera, from there. So I'm not a big fan of the sole proprietor. I always believe in at least starting with an LLC. And then what a lot of people don't understand about an LLC is an LLC can be taxed 5 different ways. It can be taxed as a sole proprietor. It can be taxed as a corporation, an S corporation, a partnership. So there are a lot of different ways that you can do it. So I like to start people off with an LLC, and then there's a natural progression as their business grows on where the entity selection takes place, right? And there's a lot of factors that go into consideration. So what I like to say is start out with a single member LLC. And then once you get up to about $50,000 or $75,000, then we reevaluate and say, okay, is our goal still the same? Now, is our goal to grow a business where we're going to take the profits out? Then that sounds like an S corporation election. If it's a situation where we're going to reinvest and not take money out and just try to straight grow the company, that may be a C corporation, right? So there's a lot of different factors that play into it regarding situation and long-term intent. Does that make sense?
It does. And so for the C Corps are out there, I'm guessing it has more to do with, like you mentioned, reinvesting profits, not necessarily head count, even though as an S Corp, you can't have more than 100 shareholders. But
Right.
for the C Corp, walk somebody through the tax implications, because, we hear oh no, you're double taxed. But like you said, if you're reinvesting it, it might make sense. So can we walk through just an example of what the tax might be for someone running a C Corp versus an S Corp?
Sure. Well, the C Corp, even though you may own 100% of the stock, a C Corp is special in that it's its own entity, right? So the C Corp is its own entity, just like a separate person. So as an owner of the C Corp, you're really just an employee of the C Corporation. So you're treated like an employee. So basically, you give yourself a reasonable salary. Okay. So that's just like every other employee. And then as the C Corp generates profits, the benefit about the C Corp is it has a low federal tax rate of 21%. And so that really allows people to pay the lower rate and reinvest that money back into the corporation. Now, if I wanted to take money out in excess of my salary, then I would have to take a dividend. And based off my income level, that dividend has certain tax ranges, but let's assume the max at 20%. So that's where your double taxation gets in, is you get taxed at the salary level. And then when you take dividends, you get taxed again at the dividend level. And that's where the double taxation comes in. But if you're in growth mode where all excess profits get reinvested back in the company, then you avoid the double taxation and you're singly taxed at the salary level.
Okay. Yeah, and from what I've heard, when 2017 tax cut came out, the C Corp became attractive again because, what was it, 35%? It went down to 21%. Is that about right?
Yeah, but again, it depends on your intent, right? So if I take a C corporation and I'm in the max bracket from a salary standpoint, and then I take out dividends, okay, so the max bracket's 37%, dividends would put me at 20%. That would put me at a 57% bracket, right, on those gains. If I'm in a S corporation, then they'll cap out at 37%.
Got it. Okay, great. Let's move on to the next thought is audit.
Oh, I said 21% and 20%. That's 41. Sorry.
Okay. No worries. Audits, is something people I think are probably scared of. So, something that might be helpful for listeners is what triggers an IRS audit? What kind of documentation and record keeping tips do they need? How long do they got to keep the stuff? If they have a CPA, so I'm kind of going over a bunch of questions, I understand, but if they have a CPA, how do they help?
Sure. So for record keeping, a common misconception is, well, I gave all my documents to my CPA, so they've got them, right? So they just use them to prepare your returns. You should always keep your records. The IRS, says anything above $75 is required for a receipt for documentation. So the best defense against an audit is good record keeping. And in situations where if you ever do get an audit, there are several different kinds. There's a mail-in audit, box audit, in-person audit, right? Just whenever you get a letter for an audit, I just recommend that you stop and contact your CPA and let them help you through that process. As far as red flags, there are several. A lot of people like to do Schedule C business income and, show losses every year. So that's a really big red flag. Being overly aggressive on, your Schedule E's, that's a big red flag. And then, charitable contributions, they do look at that as well. So those are probably the most common areas that will trigger red flags. But again, if you've got all the proper documentation, that shouldn't be a problem.
I'm curious about you mentioned charity contributions. Elaborate a little more on that if you don't mind.
Well, if you have charitable contributions that are like large non-cash contributions, or if you have contributions that are disproportionate to your income level, then sometimes those will trigger red flags. And they may be very legitimate. It could be a carryover from a prior year or something, or maybe, you took a required minimum distribution and sent it into a charity instead of taking the money. So there are other factors that can come into it. I've had a client that had $1 million income and got audited for taking a $400 charitable non-cash deduction. It's just really, and that was the only thing they questioned was $400 of charitable contributions. It was weird.
On that note I'm always surprised how many people are unaware of being able to do a donor advised fund, especially in those years when they have great income. What a great time to add some money to a donor advised fund. Do you have anybody that uses donor advised fund?
I have several clients. So I have some clients that charitable giving is paramount to them. It's very important. So they give 10% of their income every year, regardless of what it is. I've seen them do $200,000 contributions. And so what we did several years ago was set up a donor advised fund. And then that allowed them to get the deduction in the year that, they obviously wanted to make the contribution, but then let those assets grow until they decided where they want the money to get allocated. So if you're a high income earner with charitable intent, I love donor advised funds. I think they're a great planning tool.
I'll explain that just in case there's someone listening that's unfamiliar. On a donor advised fund, you're putting the money in today, getting the tax deduction today, but you control when the money goes to that particular charity and doesn't have to go to just one. And a lot of people like that because who knows, right? The charity that you're in love with today or the church or whatever, it's possible that changes, right? And all of a sudden their values are different than yours. And so you're not kind of like having remorse, if you will, and you can change who the beneficiary is of that charitable donation. Am I on the mark when I put it that way?
Yep. Yeah. And I love it. Like I said, if charitable intent is important to a client, they're great tools and they're great tax planning tools.
Okay. And I'll say one more thing on that, just for folks listening, qualified charitable distributions, that's where the individuals that are 70 and a half or older can take money directly from their IRA and send it to their charity. Do you ever see that get messed up, or most people doing that right?
I've only seen it a few times. I joke with some of my clients that, the age of the clients typically follow the CPA. So a lot of my clients aren't in the RMD stage yet.
Right.
But yeah, we do use it on occasion.
And now, a quick message from today's sponsor. If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
Well, a lot of your clients are paying estimated taxes, self-employment taxes. Do you want to share some tips on how do they avoid penalties? How much are those penalties, and just kind of how they should estimate their quarterly taxes?
Yeah, so it's the good thing that the IRS allows the estimates to be paid in arrears, right? So the calculation is made off your prior year tax. So they go, okay, if you meet the threshold of more than $150,000 in income and a greater than $1,000 tax liability, then you're required to make estimated payments, and that's either 110% of your prior year liability or 90% of your current year liability. So what I always tell people is, we calculate the estimates for them based off of their income, right? So let's say that you start a business, you make $100,000, you owe $40,000 in taxes. You're not going to get underpayment penalties and interest because it was your first year. But what they'll say is, okay, next year, because of your income level this year, Now you have to make estimated payments. And if you don't, we're going to charge you underpayment penalties and interest. So historically, they've charged you about 3%. So if you fail to pay it, it was a 3% interest rate. Not very big burden, right? But in August 2023, no one was paying their estimated taxes. So the government said, wait a minute, we need some cash. So we're going to bump that rate from 3% to 8%. And so now where you see people who historically were a little more lackadaisical in making the estimates, it's really more important to make them now because, that could be a big number at the end of the year for underpayment. So I would always recommend paying the estimates based off the advice of your CPA, right? Again, it's based off the prior year numbers. And, the 110% safe harbor provision is in case your income goes up, right? So you always want to make your estimates. But what if you're in a situation where your income's going to go down? So remember, it's 110% of prior year, 90% of current year. So what I tell clients is, okay, when I give you the estimates in April, go ahead and make the first 2 quarters, right? And then we start our tax planning process in August. So if I get to a client in August and their income's gone down from the prior year, something happened, significant event, maybe sales just were down, they hired some more employees and just the income dropped overall, then maybe we say, okay, maybe you make the 3rd quarter and you skip the 4th quarter estimate. And that way we can still get them in that 90% threshold to where they're not getting payment penalties and interest. And then they don't have to overspend or overpart with their cash. Does that make sense?
Now, if someone is making contributions into a 401k or a cash balance plan, does that help those numbers?
Absolutely. There's a couple of tricks, right? So that's part of your tax planning, right? So if we said, okay, based off of your income level, you're going to be a little bit higher than last year. So basically that means you would make your scheduled estimates, but you say, okay, we've got some free cash flow accumulated. We want to make a $100,000 profit sharing contribution that's going to lower our income and get us below that 90% of prior year. Then yeah, maybe you make the profit sharing contribution and skip the 4th quarter estimate. For smaller solopreneurs, small S-Corps, a good trick is if you don't make your estimates, right? Or basically for your S corporations, if you don't make your estimates at the end of the year, you can run W-2 wages, run yourself a bonus, withhold it all. So let's say that, you were supposed to make $75,000 in estimates all year long and you didn't. Then you run yourself $85,000 W-2 and then withhold $75,000 to the federal government, and they'll give you credit as if you've paid that in all year long, and then you can avoid that 8% underpayment penalty and interest.
Excellent. Okay, awesome. Now, another hot topic is home-based businesses, which exploded, with the pandemic and is continued. So let's kind of just go over some of the myths and facts when it comes to home office deductions, and then I have a follow-up question from that.
Sure. Home office deduction is not going to change your life, right? So a lot of people get excited about it. I'm not a big fan of it per se, right? If you truly have a home-based business, because what happens is if you have a home, you get a $500,000 exclusion on of capital gains on the sale of that home if you're married filing jointly. If you have a home-based business, now you've just entangled that into a taxable situation, right? So, but nonetheless, if you have a home-based business, be realistic about it. Be realistic about the expenses that you're claiming that are used to operate the home business. So repairs and maintenance are still an allocated percentage, but if you go redo your backyard and put in a pool, that probably didn't affect your home office. You see what I'm saying? So you might not want to include that into the allocation and deduction, right? But just be very reasonable about it. And again, record keeping is the key.
Okay. Well, how about depreciation and equipment write-offs? Are you seeing some poor execution there, or does everybody tend to get that right? And go ahead and elaborate onto the cars as well, if you don't mind.
Yeah. So if you have a home-based business now, that's, depending on your business, right? So there's a bunch of different, again, with taxes, it always depends. So with depreciation, you're going to depreciate if you're using 100 square feet and you've got a 1,000 square foot home, you're going to be depreciating 5% of your home annually, right? It's not going to shake the Richter scale. And then when you sell, you'll have to recover, right? So you get a little bit of depreciation on that. If you buy equipment for your office, printers, computers, those, I would not include those home office expenses. I would include those as business expenses, right? So I bought a printer for the business, brought a laptop for the business. I would write those off through the business. But if I go buy, a whole new bookshelf build out for the home office, then really, yes, it's for the office, but it's still part of the house. So it still goes in the percentage of that. So a lot of people miss the depreciation on the house and then are overly aggressive on like stuff like repairs and maintenance and home additions and luxury items, stuff like that. Does that make sense?
It does. It does. What about those business vehicles? Some people like to do the special bonus depreciation. Other people like to track miles. From a recommendation standpoint, when do you find it makes more sense for like what type of vehicle or what kind of mileage for someone like, hey, just write off all the miles versus, getting that big special depreciation or an amateur I can't even say it.
Amortization.
Yeah, you say that word all the time. Depreciation over a period of time. What's kind of the analysis on that?
Well, again, it's an it depends situation, right? And it varies for every business. Let's say that I have a home cleaning business and I've got a little Honda Civic. I drive all over the city to go clean homes. I probably would want to do that on mileage. Right. I'm going to drive 30,000 miles, get about $16,000 in deduction, right? And a Honda Civic probably costs $25,000. So you can get $16,000 in deductions every year. You see what I'm saying? So, but if I'm a construction contractor and I need a truck for a super and it's December and I made $1 million, I may want to write it all off in December because I can get a 42% savings on it. So it just depends on the business. Real estate agents are the same way. They drive a lot, right? So mileage may be more appropriate where, again, another construction company or another small business landscaping company, they would probably take that truck and write it off in the current year, maximize their tax savings, and then take the advantage of the time value of money and reinvest that tax either back in the business or take it in distributions.
So I'm curious on that. So let's say somebody does the big write-off and after 3 years, they are just, whatever reason, they're bored with the car and they want to get another car, whether they sell that car, trade it in, give it to a family member, are they going to have to recapture some of that depreciation?
It depends. Okay. So again, it depends on how they depreciated it, right? Bonus depreciation is typically not recapturable. If they did 179, then yeah, you would have to recapture a pro rata share of that. But either way, you're still going to pay the majority of the gain because whatever you sell, like if you sell it, then you're going to have a gain because you've got no basis. And if it's not, and if you just gift it, then yeah, you'll have to recapture some of that because you've disposed of it too soon.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.